Hello everyone. Till now, we had a good understanding with respect to all different types of cryptocurrencies as well as their tokens. Clear? So now the point which we are going to discuss now is the characteristics of these digital assets. Okay, how do they behave? Okay, what makes them different from others on all different parameters. Clear? Now, first of all, let us understand that how, see, you are investing your money. Either you can invest in the bonds, either you can invest in the real estate or stocks. But now you have an alternative, that is the digital assets, like either it can be Bitcoin, either it can be Ethereum, or it can be tokens as well, where you can store your asset. Clear? Now, the point is how it is different, in investing in shares as compared to the bitcoins, because both of them are going to give you the value. Clear? So if I'll tell you on a very basic level, in 2013 there are 70 cryptocurrencies. In 2013 there are 70 cryptocurrency, and by 2022, means you can see within the gap of 9 to 10 years, the 70 cryptocurrency have increased from 70 to 10,000. 70 to 10,000. That means there is a huge spike in the numbers of cryptocurrency which have actually entered into the market. Clear? So one thing is clear from here, that in 2013 it was only 70 cryptocurrency, and in 2022 it reached 10,000. So one thing is clear from here, that people are taking interest in these assets. That's why the number have increased so much in such a very short span of time. Clear? Because you never see that 10,000 companies have actually registered or bought their IPO in the market and they are trading publicly. No, you will never find. Means in a year hardly you can expect 50, 70, or maximum 100. Okay, but you see such a huge jump in the number of cryptocurrency. Now the first and foremost is, we have seen, personally we have seen, that big institutions like mutual funds, hedge funds, banks, they are taking interest in these digital assets. Now why? What is the reason behind that? Means you have so many assets: stocks, bonds, real estates, gold, currency. But why this digital asset? Number one, high returns. In a very short span of time, you can expect huge amount of return. This is the true fact. Second is the diversification. The more number of assets you will put in your bucket, the better the diversification of the organization. Are you clear? So now the point is to understand the main difference between the digital assets and the other normal traditional assets in which we are actually investing. Clear? So now give the point number one: inherent value difference. Inherent value difference. Inherent value difference. See, first of all, let us talk about the term value. Okay, if I'll be having a stocks, I'm getting dividends. Clear? If I'll be having the bonds, I'll be getting the coupons. Clear? If I'll be having the real estates, I'll be getting the rent in terms of regular money from the particular assets. Clear? And they all are backed by something. Means this is backed by the business. Clear? This is backed by business. This is backed by the properties. This is backed by the assets of the company. So means at the end, at the behind of these assets, there is some backing in the form of business, in the form of assets, in the form of properties. Clear? But if I'll talk about the digital asset, bitcoins, ether, stablecoin, they are not backed by anything. They are not backed by anything, nor they will give you any form of dividend, interest, or cash flow. Clear? Now the problem is, then how they are actually generating the value? How they are generating the value? The generating the value through limited supply. Through limited supply. Means suppose there are only 100 bitcoins in the market and the buyers are 10,000. Buyers are 10,000. So they will increase the demand of the bitcoins, and what will happen? And hence the price of the bitcoin will spike. Clear? And second is the belief that in future people will actually use this particular Bitcoin or this particular cryptocurrency to transfer the money, to transfer the value from one person to another for international payments. That means the use case will also increase. Are you understanding the 2 points? Limited supply, and second is the belief, the future belief that people will actually use this particular digital currency to transfer the money, to store their digital assets. Clear? Now, currently, suppose I am saying that currently 1000 users are actually using the Bitcoins. Clear? But from time to time, this number is increasing, 1000 to 10,000, now 1 lakh, now 1 crore. That means the demand for the Bitcoins is actually increasing. Clear? So now everyone is using it, but what if in the future, if the belief will fade up that now we will not use the Bitcoin, and hence the price can also crash? Means at present I have a belief that people will use it in the future, but gradually it can also happen that the price can come down with the belief that now there is a no use of these Bitcoins. So the Bitcoin's price movement is solely based on the demand and supply. Clear? Now coming to the second point, give the heading transaction validation difference. Transaction validation difference. Transaction validation difference. See, if I talk about the traditional assets like shares and bonds, they are handled by the central intermediaries like a stock exchange, or either it can be your banks, or it can be your depositories like NSDL or CDSL. Okay, so they have their own private ledger in which they maintain that, okay, Mr. Ram holds 100 shares of Reliance, 200 shares of Infosys, 150 shares of HAL, and so on. Clear? So it's a private ledger, means the record of actually who own that particular asset. Clear? But in case of digital asset, like if I'll give you the example of Bitcoins, they are recorded on the public blockchain. They are recorded on public blockchain. We all know that there is a blockchain, clear, in which all these data are stored, and this is a decentralized ledger. This is a decentralized ledger. That means there is no bank or no government actually they can control it. Okay, so we have a public blockchain in which all the data is there. Clear? And you have your own wallet in which you can see what actually you owns. In this you can actually see what you owns, but it is not controlled by any third party. Clear? So it can be said that it is peer to peer without any middleman. Means it's my wallet, and it's your wallet. So I have transferred the money to you, so now it is showing in your wallet. See, earlier I have a say $100 Bitcoin. Clear? I have transferred 10 to you, and you earlier had the balance of say $40. So when I have transferred 10, this is your new balance of the wallet, and my new balance of the wallet is $90. But in case of shares, what's happening? Seller and buyer, middleman is over here transferring the share to the middleman, and this middleman actually doing what? He have two ledgers, say Ram and Shyam. Clear? So in these ledger he will transfer the shares of say 100 Reliance from Ram to the ledger of Shyam. Clear? Now try to understand another difference. The difference of is the medium of exchange. See, we pay the money, either it is in rupee or in dollars or in yuan or anything. Clear? Or in euros or in any currency, to actually buy the stocks, to buy the bonds, to buy the gold, because they are traded in the fiat currencies. Clear? Clear? Like INR, USD, Euro, and these particular fiat currencies are backed by the central government because they are the government issued money. Clear? So if you buy this particular asset in USD, then when you sell, you will get the USD. Means you paid USD and now you are getting the USD. Clear? But the purpose of the digital asset is to replace the fiat money. Means they want that people should not use the fiat money, the money which is created by the government. What they want that people will trade in the bitcoins. Means this is a shopkeeper, he sold the shoes, okay, this is the buyer, so he took the shoes, and rather than paying the dollar or the rupee or the euro, what he gave bitcoins. So this is a transactional value where you have actually transferred it, the bitcoins, to this shopkeeper. And now suppose shopkeeper want the food for his family, then he went to another shopkeeper, he took the food for the family, and then he gave those bitcoins. So rather than using the money, they are using the bitcoin. So the purpose is to replace the fiat currency. This is the reason that digital assets were created. Are you clear? Now coming to the fourth and the final point, that is your regulatory difference. So we all know that this currency, whether it is stocks or whether it is bonds, they all are highly regulated by the SEBI, regulated by the RBI, Federal Reserve, central bank of that particular country. There is a dedicated set of written rules for the investors protection. It is transparent, it is safe. But digital asset, the point is no, they are not properly regulated. There is no defined single law, rules and regulation which is managed by the whole world. Every country treat them differently. Some even have banned it, some even are utilizing or saying that we have to use the bitcoin but with a very minimal use case. Clear? Means they have put lots of restrictions on it. Clear? In the US, some regulators call them as a commodity, some even call them as a property, and some even define them as a non-financial assets. But sir, you have said that there is an exchange for the cryptocurrency, and you have given the example to us like WazirX and Behance, but they are also unregulated. Okay, there is no supervision from the RBI, there is no supervision from the SEBI. Okay, so it can lead to huge amount of scam, market manipulation, price manipulations, anything is possible. Clear? Hope you got the complete understanding of the characteristics of the bitcoins. Clear? Okay, so I'm ending this lecture here and we'll continue in the next lecture. Thank you.